Hello and welcome to Bytesize Newscast number 7. It's so good to be back. Seriously, over the last couple of days I didn't have access to my recording equipment, but I managed to prepare a ton of content. So over the next couple of days I'll be coming out guns a-blazing, so sit back and enjoy being informed. In today's Bytesize Newscast, Disney's gonna lay off 32,000 employees. That's a lot of people. And on top of that, Disney has made their first loss since 2001. So big news. Next, institutional money is entering the Bitcoin and by extension crypto space. Powerful Raoul Pal has some interesting things to say on the topic. So we'll have a look exactly what he said and how to make sense of that. Next, China versus the rest? Are we in the midst of a Cold War 2.0? I think we are, and I'll share with you exactly why I think that is. And finally, last but not least, I hope to teach you guys something about percentages as we have a look at GDP growth in the United States. Before we jump in, some housekeeping. If you like the content or have any questions, please leave a comment below and don't forget to subscribe to stay updated on the most important economic developments as they happen in the crypto and wider economic space. Also, the following is not financial advice, it is strictly educational. So let's get started. It looks like Disney is going through some very trying times. And let me actually start off with this quote right here. Disney plans to lay off around 32,000 employees, mainly its theme park business, the company has announced in a 10-K filing. The company says it's making these redundancies due to the current climate, including COVID-19 impacts. Now, what makes this notable is two things. One, the sheer number of employees. At 32,000 of 155,000 employees, that's over 21% of the total workforce. Let me put that another way. 1 in 5 employees is losing their job. Now, the effect of this, I imagine, will be a lot more automation. And what I mean to say is we see it here in where I live in supermarkets and shops, where cashier jobs are being replaced by automation. And what I imagine is that it will happen at Disney too, where most of the jobs that are lost are actually being replaced by automation or some form of optimization. Now, naturally, you can imagine Disney won't get rid of those Mickey Mouse characters walking around the theme parks, but I imagine there will definitely be some changes in the shops and gates. Now, second, this piece here gives an indication. Along with the layoffs, Disney said it's considering additional measures like reducing its investment in film and TV content, halting capital spending, and furloughing more employees. So furloughing are also happening in other components of Disney, like the film and TV content. And this is simply due to the fact that Disney has not been able to lucratively cast movies in cinemas because nobody's going to cinemas right now. Now, I'm pretty sure these jobs will come back in one form or another, as TV and film content picks back up. And that's because, as it stands now, Disney has a ton of content in the backlog and stages of production. Needless to say, these stages of production are functioning at a lesser capacity now. But once this starts to pick up, so will the hiring process. So there's two big things happening right now. First, a lot of people getting fired from their jobs, and these jobs are probably not coming back into theme parks because they're going to be replaced by optimization and automation, right? On the other hand, there is some other layoffs in the film and TV content. Now, I imagine that most of these layoffs will be temporary. People get rehired back as TV content and film content starts to become lucrative again. Now, I wanted to show you something else. These layoffs were announced back in September, right? And as we can see, there's initial drop in the price as a result. And what is interesting, however, is there's a strong rebound after this initial news. Their theme parks haven't opened up, their movies haven't gone back on. So where is this coming from? And the way this works is when the news was first announced, everyone thought, okay, this is the end for Disney. First loss since 2001, or 2001, furloughing people, movies are not working, right? And people getting fired is a obvious indication that a company is suffering and the company needs to take action. And this resulted obviously in a share in price because Disney is perceived as a COVID loser. But what happens instead is that the financial outlook for Disney actually began to look a lot better towards November. And the stock price responded because people caught on to the news. And this is actually explained in the article here. In August, like we said, August, September, the company reported a loss of 4.72 billion for the first quarter, which the Wall Street Journal records was the first quarterly loss since 2001. It followed with a further loss of 720 million in the following quarter. Now, obviously, 710 million is a big loss, but it's a lot smaller than 4.72 billion. Actually, it's 4 billion less. And this is the effect of firing people. As cruel as it might sound, you do save a lot of money. Now, coupled with the fact that Disney's online content platform, Disney Plus, is actually booming, their outlook changed to positive, and this is reflected in the stock price. Now, I think as it stands, Disney will have a very strong 2021 coming off the back of the COVID crisis. And that's because there's a lot of pent-up demand in the theme park. There's a massive backlog of movies, film, and series content. And on top of that, they're going to come down with a trimmed down workforce that is optimized through digitization. And this gives me a strong indication that Disney will have a pretty profitable 2021 and onwards. Many of you probably know Raoul Pal. Now, for those of you who don't, he is the CEO of Real Vision Finance, which is a great platform for macro investing and crypto content. Now, personally, I'm not affiliated with them, but I do like to listen to their interviews. They're incredibly informative, and I highly recommend checking them out. Anyways, Raoul Pal recently sat down and discussed institutional investing in the Bitcoin space. Now, institutional money are people and businesses that manage large quantities of money for other people. You can think of like banks and money businesses and family offices, for example. Now, why this is important to note is because the last bull market in Bitcoin and the wider crypto market was actually driven by retail. And this is evident from the fact that during this period, like 2017, a large amount of Bitcoin just remained on exchanges. It was never moved off. It was remained on exchanges, ready to be sold. And that's very contrary to what's happening now. I covered this in a previous video. Bitcoin is now moving off exchanges. It's not staying on exchanges ready to be sold. Now, Raoul Pal is very well connected in the institutional space and has a very clear idea what's going on there. So his words are actually very good sources of information. But what I do want you guys to take away from the fact that from this finding is that people like Raoul Pal are intelligent. They're not stupid, and they understand when they make the following statement. And this is coming from his Twitter. So I'm quoting Raoul Pal on Twitter right now. Okay, a last bomb. I have a sell order in tomorrow to sell all my gold and scale in to buy BTC and ETH 80-20. So 80% Bitcoin, 20% ETH. I don't own anything else except some bond calls and some dollars. 98% of my liquid net worth is invested in BTC and ETH. So you can't categorize me except irresponsibly long. A good night, all. Now, people like Raoul Pal understand that their influence can actually have an influence on the price of the underlying asset. Now think of it from his perspective. Would you first buy the asset and then announce it? Or would you announce it first and then buy the asset? I'm pretty sure you would announce it first, or you would buy it first and then announce it, right? Now, institutions are also smart. They understand as much as Raoul does that when they make an announcement on something, it influences the price. So what I want you guys to take away from all this is the fact that news like this is essentially old. And my reasoning is that most institutions have already, for the most part, bought into crypto. And those that are not, those institutions that have not bought into crypto are currently waiting on the sidelines very patiently for the next big dip to buy in. Now, Raw says in this article on Bitcoin Maximalist, from what I know, and I know a lot of people in the industry, they're all onboarding institutional clients, family offices, and endowments at an enormous pace. And what this looks like is asset managers like Guggenheim, who managed hundreds of billions of dollars in assets and are looking to gain exposure to Bitcoin and crypto. Let me actually pop this in here for you guys. Um, so this is on the block. It's on Guggenheim, the firm Guggenheim, which invests across asset classes on behalf of companies, pension funds, and sovereign wealth funds, wrote in a filing on November 27th that it might seek investment exposure to Bitcoin indirectly via Grayscale's Bitcoin Trust product through its Macro Opportunities Fund. Now, the fund they're talking about here is the Macro Opportunities Fund, which has around $5 billion under management. What this means is that we could see, or like I said, probably have already seen, a $500 million inflow of capital into the Bitcoin market. Now, this is a staggering amount. And what it makes it even more staggering is the fact that these large funds are well connected and would prefer to buy Bitcoin straight from the miners. Now, this is a double win for the miners and the funds. One win is that they don't have to sell on an exchange and pay the fees. Clear, easy victory. The other win is that both parties can actually agree on a price beforehand. And this is a great way of doing business because it makes everything predictable. And predictability is an awesome thing in the big business world. Now, the effects of this are actually described, I'm going to jump back to the other article now, are actually described by Raoul here. There is no supply because it's being bought straight from the miners. I have literally never seen a situation like this before, where there is no supply coming into the market and demand is going up every day because institutions are coming in. In other words, all of the new Bitcoin coming in is being bought up by these big corporations, meaning that the supply of Bitcoin is running dry. This, in short, is extremely bullish for Bitcoin. You can imagine if the supply of anything runs dry, but the demand stays the same or increases, the price will go up. So what have I described here? First, institutions are coming in, but you have to remember that when an institution announces it, they've already probably landed, right? So announcements are actually after the fact. So it's not something to look forward to, it's actually something to look back on. And also, the supply of Bitcoin is running dry. These institutions are buying straight from the miners. This means that new Bitcoin coming in is well below what you would expect previously. Now, towards the end of this article, Raw predicts the price of Bitcoin to hit 150,000 in the next 12 months. Personally, I think it's a little high. I predict we'll hit like 50K at the end of the year, after a solid correction in 2021. Now, I'd love to hear what you guys think Bitcoin will do next year. What are some of your end of the year predictions? Let me know in the comments down below. Now, the next topic I want to engage with is the topic of China. Now, China has become a very big player in both the economic and political world in recent years. And this is important to note because other regions of the world don't seem to be all that happy with how China is going about it or its business. And these are regions like Europe, the US and Vietnam, Japan, Australia, and the effect of that is that we're currently in some type of cold war. Now the difference between this cold war or alleged Cold War and the Cold War between the US and Russia is the fact that this one is just way more economic and political and influence in nature than the Cold War between Russia and the US, which had much more military tension. Now, the first part of winning a Cold War in this new Cold War era is allegiances. Now, in essence, if you are a bigger group of countries, you are bound to be more powerful. And it also makes settling democratic disputes easier. Now, I found evidence of this in two articles that I found. The first, EU proposes new post-Trump alliance with the US in face of China threat. So that's the first one, the EU and the US aligning together against China. And the second one is historic Australia-Japan defense pact. Australia and Japan have agreed on a historic defense pact that would allow both countries to strengthen military ties in face of rising tensions with China. So we get these allegiances against China. Australia, Japan allegiance, EU, yes, allegiance against China, just to create a new block of democratic power that's underlined somewhat by military power. But you can imagine Australia and Japan are hardly going to go to war with China. It's not going to happen. Anyways, the second element is economy. Simply put, if you can starve another country of their financial resources, it's just going to be way more difficult for them to outcompete on an economic level. And this makes it hard to do many things. Like it makes it hard to establish a big army. But more importantly, having a stronger economy means that it's going to just be much easier to sit out and impose tariffs or kind of do other forms of sanctions. And an excellent example of that is the ongoing trade war between the US and China. Now, the final component I think that is very important in this Cold War is winning the hearts and minds of people, by demonstrating that your ideology is superior. And what I mean by this is that you want a group of countries to be right. You want to demonstrate that your way of thinking is superior. And this is kind of demonstrated in the following article. On Al Jazeera, it's called A New Belt and Road, US Taiwan Hookup to Counter China's Efforts. So what is this major difference? Well, China provides a lot of money through their government, right? It's a very government-led capitalism. On the other hand, Taiwan and US are using capital raised from the private sector. So it's very much that free market capitalism. It's almost as if we're revisiting that communism versus capitalism all over. Now the important takeaway here is not to just to pick a side. That's a matter of personal preference, you know. But what is important to take away from the perspective of an investor is that you need to be aware of the fact that this is going on. And this will help you get understanding as to why political leaders make certain decisions. Now, let me give you an example on that. Do you remember how badly Trump went after TikTok? Now, most of us think he did this because he wanted to take a jab at China and help the likes of Facebook. But this is wrong, and let me explain why. TikTok has an incredibly effective algorithm which is very well protected by the Chinese. And what Trump wanted to accomplish is he wanted the Americans to get their hands on this algorithm. Why? Because it will be a very important tool in influencing the hearts and minds of people. At the same time, it can give you an exceptionally deep information on the users of the app. Like, why do Americans have such a big problem with TikTok? Well, because TikTok, by law, is supposed to share all their data with the Chinese government. So TikTok is a huge spying operation, essentially. Now, returning to what I said earlier, I think we're in the middle of a Cold War. And this is evidenced by the fact that we have this ideology clash of capital raised from the private sector versus government money, and we're getting these defense pacts and these democratic pacts, excuse me. And It may seem weird, but it will help you understand why Trump went after TikTok. And this understanding of this like Cold War, it's once again, it's not important to choose sides, but it's just important to know that it's going on, and it'll help you make sense of the world, and it'll make you a better macro investor. The final thing I wanted to jump in for today is this article on CNBC. US economy grew at an unrevised 33.1% rate in the third quarter. Now, this article posts a historic pace of expansion in the US economy, and it seems to be very, very positive. And let me actually quote the exact sentence that caught my eye. Gross domestic product grew at an unrevised 33.1% annualized rate, the government said in a second estimate of a third quarter output, confirming the economy's historic pace of expansion in the third quarter. Now, the second part of this is the economy contracted at a 31.4% rate in the second quarter. Now, when you hear or read this for the first time, you may think, oh wow, the US contracted 31.4%, but they grew 33.1%. That's incredible. The US economy actually grew out of Corona. But this is false. And let me show you why I made this. I'm a master of Excel, so calm down, okay? Q1, let's say the economy is at 100 points or 100%. Now in Q2, it contracts, there's a little calculation here, by 31.4% to 68.6. That makes sense, right? Now the interesting part is where the economy grew by 31 point or 33.1%. And what you see is it doesn't actually return to 100%. Actually, it's on 92%, just under 92%. And what's happened here is that the economy grew 33% from a much smaller number. So the increase in absolute sense is actually lower. And this is the key takeaway I want to share with you guys. Percentages are funky creatures. When something goes down 10% and then goes up 10%, it doesn't actually mean it returns to the same value. So just remember to always be wary of this, and when you read an article like this, just make sure you do a little math on your phone and you'll be much better off it. Alright, ladies and gentlemen, that concludes today's newscast. Now, in short, what did we learn today? First, automatization and digitization coupled with pent-up demand will give Disney a great 2021 and onwards. Next, institutional investors are smart people. They understand that posting will drive the price up, so they post after the facts. Also, we learned that Bitcoin's supply is running dry, which is extremely bullish for Bitcoin. And in the China versus the West, we understand now that there is a Cold War, a next generation of Cold War, which is more democratic and more economic in nature and less military. And it's not important to pick a side, it's just important to understand that it's going on because you will make better sense of the world. And finally, we learned something about percentages. Percentages are funky little creatures, and it's always better to do a little bit of, some calculations here and there just to make sure you're not being deceived. Now, I want to thank you all for listening, and I want to see you in the next episode of Bytesize. So, in order to drive up the algos, please leave a comment and subscribe. I greatly appreciate it. And once again, I totally look forward to the next episode of Bytesize. See you guys then.